All right, good morning, and thank you so much for joining us for our 2025 second quarter market and economic recap. Needless to say, the second quarter was quite eventful. We had the initial rollout of the tariffs from the administration, the subsequent market response, leading to a lot of volatility and declines, and then a market recovery. Today, we're going to kind of take a deep dive into where things stand on the equity markets. We will touch upon the fixed income markets. We'll be doing an update on the economy, and then we have some very interesting slides in terms of some perspectives on the overall market. And just a couple of house cleaning items before we dive in. You are able to type questions in if you'd like. We will cover those at the end of today's presentation, but if any question comes to mind at any point during the conversation, feel free to type that in and we'll be sure to get to it at the end during our Q&A session. And we will, as always, be recording today's webinar, and we will send out that recording within a week or so. So feel free to share that with anyone you think may find today's discussion of interest. And with that, I'm going to turn it over to Evan Barnes, and he is going to start us off with diving into where things stand with the equity markets.
Thank you, Drew. And thank you everybody for joining today. As Drew mentioned, the first quarter of the year and going into April was quite a volatile and somewhat uncertain time with changing administration, tariffs, those types of things. And then we saw a nice recovery as well. So these numbers are looking much better than what we were discussing on our first quarter economic and market update. On the screen now, you should see the stock index performances. So these are the major indexes that we track here internally. And a lot of them are pretty familiar, especially the top three. Okay, so if we're looking under the year-to-date column, and we look at the Dow Jones, the S&P 500, and the NASDAQ, those are the three kind of major indexes that the news media likes to speak to. The Dow Jones being up 6.33% for the year. You can see over the last 12 months, basically July to July, the Dow is up about 16%. All the way on the far right, if we look over there, the average return annually over the last 5 years, almost 14% a year. All right. And so if we look at a couple other key ones we'll point out here, we're not going to go over all of them, but just want to catch some themes here. The S&P 500 up about 7.5% year to date. These are through July 3rd. So we had last week as well. The market was fairly flat last week, a little bit up, but these numbers are still representing the market well. So we're at 7.5% year to date on the S&P 500. The NASDAQ, which tends to be more of the growth-oriented, more tech-heavy type stocks inside the NASDAQ 100, up 9% year to date. If you look on the far right, that's where a lot of the returns have come from annually. Over the last 5 years, the NASDAQ being up about 18% per year. All right. And as we kind of go down the rest of the list here, the difference between growth and value. So you can see S&P 500, growth and value, mid cap 400, small cap 600, and then broken down between growth and value as well. And when we're looking at the S&P 500, so larger corporations, we're going to talk a little bit more about the big ones here in a second, but the large cap S&P 500 growth is up almost 10% this year. Value-oriented stocks, which would be more banks, utilities, energy companies, dividend-paying type stocks tend to be more on the value side of things, up about 5% this year. On the mid and the small side of the economy, in terms of here in the U.S., these are U.S.-based stocks, mid and small cap. Growth and value, 2.7%, 3.5%. The only one we see negative for the year so far is going to be your small cap value. Small cap value down around 3%. So again, the theme over the last few years, whether it's large cap, mid and small, for the most part, growth has outdone value outside of mid cap this year, but growth-oriented stocks tend to have tended to do better over the last few years. This was a pleasant surprise this year, and we appreciate that. This speaks to our diversification. Part of your allocation is international stocks. International stocks have done really well in 2025. So the MSCI EAFE, Europe, Australasia, and Far East, this is going to be your developed international countries, Europe, Asia, Japan, Canada, those countries are going to be in there, up almost 20% year to date. If we go down a couple more to the second from the bottom, emerging markets, China, India, Brazil, those economies, those stock markets are up 16.74% this year. So having that diversification internationally has definitely helped out. And it's been a while since international has outperformed the US markets, but that is happening so far this year. We're going to talk more about commodities here in a second. That's the bottom one. But again, kind of recapping the first half of the year, these numbers look pretty solid. If we did this webinar a month and a half ago, it would not have looked as solid. We've seen a really nice recovery, which we'll talk about here, from the pullback we saw in February, March, and April. When we look at the different sectors, so what parts of the stock market are doing well, what different parts of the economy are showing up. On the left-hand side here, you can see year to date, industrial type stocks have done really well, up almost 15% this year. Utilities and technology round out the top three on the year-to-date returns. This is through the end of last week, so these are very up to date. As you kind of move into the middle part of the sectors that are a part of the S&P 500, you got your materials, communication services, and financials. We're going to keep going to the right. Consumer discretion. So when you think of stocks that are based on how much consumers are spending, Drew's going to talk about that when we get to the economy. Consumer discretionary stocks and healthcare are the two sectors of the economy that are negative so far. Drew's also going to dive into real estate, so I'll let him do that. But again, this is kind of showing you the moving parts of the stock market and how you can't just put all your eggs in the one basket, because if you look on the right-hand side, the title of this is "The Only Constant is Change." The top three sectors in terms of performance over the last 4 quarters have changed every quarter. Okay, so there's some that have been in the top 4 quarters ago that just repeated, but for the most part, things are moving around. And if you look at the last quarter two, 2025, tech, communication services, and in industrials, and compare that to the first quarter. Okay, the first quarter of 2025, energy, healthcare, consumer staples, the more defensive type stocks. The first quarter, there was more uncertainty. People were going into places in the economy and in the stock market that we consider more defensive, that are going to kind of be there whether we're going through an economic pullback or not, or if there's just uncertainty. People know you're going to need energy, healthcare, and consumer staples like toothpaste and toilet paper, stuff like that. Okay, so that was kind of the first quarter of 2025. Then the rebound in the second quarter is going to be more of those growth-oriented type of industries. And you can go back to the end of last year: utilities, real estate, industrials, consumer discretion, communication services, financials. Everybody seems to have taken part at least at one point in the last 4 quarters. And again, this is part of the market. The market is constantly taking in information, trying to understand where the best place to deploy capital, and it's going to change from quarter to quarter. Okay, what this is showing us is on the left-hand side, we're focusing on the PE of the top 10 stocks in the market, the remaining 493 other stocks of the S&P 500, and the S&P 500 itself on here. PE is the price to earnings ratio. How much does it cost per dollar of earnings when it comes to investing in stocks? That's basically how expensive are they. Okay. On the left-hand side, we're looking at the top 10 stocks currently have a PE ratio of 29. All right. The average at 20, and let's compare it to the S&P 500, the third one down in this box. The S&P is at 22. The top 10 stocks are more expensive. Now I'm going to show you on the right-hand side where that's probably well deserved. But again, the stock market in general has been more, you have to pay more per dollar of earnings than we have historically. And just to point out the top 10 stocks here at the bottom in the fine print, you got Nvidia, Apple, Amazon, Google, Meta, which is Facebook, Broadcom, Berkshire Hathaway, Tesla, JP Morgan. Okay. Seven, eight tech stocks, and then JP Morgan and Berkshire Hathaway. Um, those are the 10 largest stocks in the S&P 500. If we look though, whether it is the top 10 stocks, the remaining 493, or the S&P 500, the current price to earnings ratio, the how much you have to pay per dollar of earnings is higher than the average, and you can see the percentage. So the top 10 stocks are 109 or 39% of the average of those 10 stocks. S&P 500, 132%, the remaining stocks at 131. Long story short, stocks are pricier as we're reaching all-time highs at the moment. Okay, on the right-hand side, we're looking at the weight. How large are those big stocks? We've talked about the Magnificent Seven many times over the last few webinars that we've done. But when you bring in those other three stocks to round out the top 10, how big are they? All right. So the market capitalization of the top 10 stocks, 38.2%. This goes back to 1996. Look at the ride we've taken and how much they have spiked over the last 10 years to the size. They almost make up 40% of the S&P 500. So when those stocks are moving, the S&P tends to move with them. But as I mentioned, when it comes to, hey, yeah, they might be more expensive, but it could be justified, is the earnings part of this, is the earnings on the top 10 stocks. 32% of the total earnings on the S&P 500 come from 10 stocks. Okay, so again, they might be highly priced, but at least they are making money. This isn't coming back to 2000 when you see the market cap and the earnings are really high, where we were in the tech bubble, and a lot of companies weren't really backing up their high PE ratios with actual earnings. These bigger companies are doing that these days. All right. So we talked about how we had some volatility this year, and this slide here is showing us the returns going into our correction. Okay, correction's a 10% pullback in the S&P 500, a bear market's 20%. From February 19th to April 8th, we had our pullback. Okay, the S&P 500 is here on the far right-hand side, and the S&P pulled back 19% over that time. All right, so almost bear market territory. And then you can see each sector and what they did over that time. The tech stocks pulling back 22 or 26%, excuse me, over that almost 2-month time period. All right, real estate down 12, materials 17, industrial 16. You kind of catch the theme here. We saw pullbacks even in consumer staples and utilities, which are the safer type stocks, the less volatile stocks. We saw a 7.7% pullback and an 8.7%. So there wasn't really a place to hide from that volatility, but some were more severe than others. How about this, though, when the administration paused the tariffs for 90 days, the S&P 500 went up 9% that day and continued its recovery. So if we're looking at the returns coming out of that correction, so April 8th, and this is through June 11th, so we're better than this now. This is about a month ago. The S&P, remember, was down almost 19% on the pullback. It rebounded 20.6%, and obviously we're much higher than that now. But if you got out at the bottom, it really costs you, not just in the short term, but over time, because the compounding effects of returns it really makes a big impact if you're not in the market for those recoveries. All right, a big talk this year in the markets hasn't just been kind of the tariffs and the market volatility and recovery, but also commodities. And so this is an interesting slide just from a comparison perspective from a year ago. So it's July 4th of 2024, July 4th of this year, and then in the middle here is how these commodity prices ended 2024. So let's look at oil here. A year ago, July 4th, oil was at $85 a barrel. Coming into this year, $72. We are now currently, this is through at July 4th, at just below $67 a barrel. So a big drop when it comes to oil prices flows through to gas, right? So we look at a year ago, we were at $3.48. Now we're at $3.16. Drew's going to dive into inflation numbers more here in a second, and kind of where inflation comes from. Energy has a big impact on inflation numbers. Okay, so Drew will dive into that for us here in a second. Natural gas has gone up $2 to $3.41. But the big drivers of the commodity index, which is this one here at the bottom, the commodity index, a year ago, 241, coming into this year, almost the same, 238, but now we're up to 255 on this commodities index, which typically is driven by energy, is kind of the biggest factor. But this year it's been those precious metals. Check out gold. Gold at 33.32 per ounce on July 4th of this year. That's $1,000 more than we saw last July 4th. Global uncertainty, there's talks about the BRICS nations, are they going to do something different when it comes to the reserve currency, devaluing of dollar? Are we running debt and deficits to a point that there needs to be some type of safe haven? Those are kind of the drivers behind that, those gold prices. And silver's up too, from $30 to almost 37. Copper, not up as much, but it definitely has gone up. Corn prices, so even agriculture prices have risen a little bit as well. But the energy on the other side has come down. So Drew's going to dive into the inflation numbers, and we'll talk about how the commodity prices will affect those. All right. 2025 fixed income and interest rates. Okay, so we talked about stocks. Now let's talk about the fixed income world and bonds. When it comes to bonds, it has been very nice to see that this year bond prices and bond returns have been much more like bonds have been in the past, meaning that we're using them to generate income, getting some additional return, but also take risk off the table when it comes to volatility. Okay, so when we saw volatility earlier this year, we actually had bonds act like bonds again. 2022, that wasn't the case when we had a bear market. When inflation was really high in the summer of 2022, the Federal Reserve increased interest rates dramatically. Bonds did not give us much of a safe haven that year because we have that teeter-totter effect where interest rates up, bond prices down. But this year, we're actually seeing some return to normalcy when it comes to bonds. And we had mentioned that before coming into the year that we felt like this, that we were pretty positive on the bond side of things. And so if you look at the US aggregate bond index, the very top one here, year to date, up around 3%. All right, so for basically the first half of the year, 3% increase on the aggregate bond index is fairly solid. If we repeat that, if you go over 6% in bonds, that's kind of what we're looking for, what we're hoping for. If interest rates remain where they're at now, you know what the next 12 months return would be by looking at the yield. Okay, so the yield over here, 4.67%. If interest rates don't move at all, meaning bond prices don't move, that's what your return is going to be for the next 12 months. All right, so those yields are still pretty attractive. Talk about the Fed and short-term rates here in a second, but at the moment, the yield on the aggregate bond index at about 4.67%. All right, corporate bonds, when it comes to yield at 5, municipals 3.63, high yield bonds at 7.36. Under the year-to-date column, everything's positive. All right. Municipal bonds, which have some tax favorability when it comes to their interest, typically have slightly lower returns. But when you look at the tax equivalent yield or return compared to traditional bonds, it makes sense that the municipals are a little bit lower, but still positive for the year. And then we look at the key interest rates. Key interest rates down here at the bottom. The one that the market focuses on the most that we tend to internally here also like to look at because a lot of interest rates are based off of this when it comes to loans and those types of things is going to be the second one down, the 10-year Treasury. So the 10-year Treasury, um, that interest rate currently is about 4.43%. All right, it's bounced around a little bit this year, but it's been much calmer than we've seen in the last few years. If we go a couple more over, look at what we had coming into the year. Okay, so coming into 2025, the 10-year Treasury was at 4.58%. So it has come down some. We've seen it lower than it is currently. But the interest rate on the 10-year coming down has helped those prices with the teeter-totter going the other way. Interest rates down, bond prices come up a little bit. Um, and so that's a good to see. Drew's going to talk more here about real estate during his economic update, but I like to point this out because everybody has had some experience, if not currently, with real estate. And so we look at 30-year fixed mortgage, the second one down here from the bottom, at 6.74% is what we're seeing on a 30-year. Coming into the year is at 7.28. So it has come down some, um, but we've seen a slowdown in real estate. A lot of it has to do with supply demand numbers, but also what's going on with mortgages. Because during COVID, a lot of people refinanced at 2.75, 3% to move and take on twice the interest rate. That's definitely a factor in the slowdown that we've seen in interest rates. Prime rate at the bottom, still hanging out at 7.5%. So that's the interest rate that banks lend to their um, credit quality type businesses. So that's still pretty high. So when we were talking earlier about um, large cap stocks, small cap stocks, small cap and mid-sized stocks haven't done as well. A lot of that is just some economic uncertainty earlier in the year, but also tariffs, but in particular, interest rates. Smaller companies tend to borrow more, and when they do at higher rates, that's going to squeeze their margins. So we're always keeping an eye on what's going on with interest rates when it comes to corporate lending. All right. So what this chart's showing us here is the nominal and real U.S. 10-year Treasury yields. What we mean by that is the basically the yield we talked about before, the nominal yield currently on the 10-year Treasury as of June 30th, the yield we were getting was 4.24%. Okay, so if we bought you a 10-year Treasury, it's making 4.24%. That's lower than historically, as you can see on this chart. We were up at 15.84% back in on September 30th of 1981, right? Back in those days, interest rates are quite high. All right, and now we're down to 4.24, but it's getting back more into the normal-ish range when it comes to yields on the 10-year Treasury. But if that's what you were making, what's kind of your net return when you take into account inflation? So inflation, if you take the 2.77% inflation rate on June 30th away from our 4.24% yield, our real yield's around 1.5%. Okay, because your purchasing power, your returns are going to be impacted by inflation. Okay, and we look at our average since 1958, you can see that normal yields are hanging out at about 5.73%. So we are below that. Now consider the fact that there were some really big return or yields back here in the 80s, 70s and 80s that are going to impact that 5.73. But we have some really low ones that are impacting our 4.24. Real yields, though, 1.92. So we're still trailing what we had historically going back into the to the late 50s in terms of what you're really kind of putting into your pocket. Because if we were getting real yields or normal yields at about 5.73, you take off inflation, 3.8, that's where you're going to get the 1.92. So we're still not yielding as much as we have in the past, but we're starting to get closer to it. All right, those real yields, if you look down here, obviously COVID made a big impact, and when inflation spiked and the Fed jacked up interest rates, there was kind of a disconnect here in the 2020, 2021, 2023 range. But we're starting to get back to more normal yields. We're taking that into consideration when we're building portfolios for you. If we're trying to generate income in retirement, then we want to make sure we're taking into consideration inflation rates as part of our plan to make sure that your real income, your real yield is sufficient for the plan that we put together for you. Last thing I have in here for interest rates is going to be the Fed. All right, so won't be a day or two that goes by without the conversation around the U.S. Federal Reserve. Powell catching a lot of heat for not cutting interest rates yet this year. A lot of countries across the globe have started to cut. We have not done so in 2025. At the end of 2024, we did see a cut. But the expectation currently I'm going to do just focus more on the right-hand side here. Right now, we're at 4.33%. And this is kind of projecting out rate cuts. I'm not going to focus a whole lot on the far right-hand side here because the projections really haven't met reality when it comes to projecting what the Fed's going to do. But if we look at the rest of this year, there is a decent chance, and we believe internally here we'll see a Fed rate cut or two from 4.33. By the end of the year, we're looking at the federal funds rate coming down to 3.67 is kind of the implied rate or what people are pricing in to the market. I'm not sure it's going to go down that far, but it could. If we look at the top here, the current effective federal funds rate 4.33, and the market is pricing an additional 67 basis points, which is a 0.67 cut by the end of the year. All right. That's priced in. If we don't get that, we will see some volatility. All right. Because inflation, Drew's going to talk about in a second, has been better. We'll talk about how the dual mandate for the Fed is inflation and jobs. And if we can continue to see pretty good numbers there and we don't get a cut, the market's not going to like that so much. So that's something to watch pretty closely. And we're doing that internally here. And we'll send out communications if we feel like it's necessary. But I'm going to jump forward here and let Drew get into the economy.
All right, thank you for that, Evan. And so when we look at the dual mandate that Evan mentioned, the Fed has two main criteria in which they tend to base policy decisions off of. And the first is inflation. So Evan mentioned that when inflation took off, and we can see obviously this is a chart of inflation in June of 2022, it reached 9.1%. The Federal Reserve behind the eight ball, but they had to jack up interest rates quite high, quite quickly. So inflation being, one of the main criteria in which they base their policy and interest rates off of. The other is employment, which we'll look at on the next slide. So if we look at the components of inflation, we can see that, it's built up of energy, shelter, food, core goods, insurance, dining and recreation. And what you can really see here, I think it's about 40% of the overall index is shelter. And that's these dark blue lines down here. So we're actually starting to see a trend down. But when inflation was peaking, we had major contributions from energy. Since inflation has fallen, we've seen energy actually be net negative and helped us pull inflation down. So coming into 2025 and certainly going into the second quarter, a big fear is we're now rolling out these tariffs, and what if tariffs drive up inflation a lot and increase the cost of goods? Now, we've long kind of thought that those fears were overdone because, if you have a 10, 20% tariff, you can't necessarily just pass that all on to the consumer. And I'll show you where the consumer stands here in a moment, because the dynamics of price and demand, or I'm sorry, supply and demand still are what they are. So if a consumer is stretched and kind of tapped out, they're not going to buy your good if you're charging 20% more. So that means the folks that are exporting or the folks that are importing are going to have to eat those costs. So there could be implications for earnings as a result of that. But in terms of it driving inflation in a serious and meaningful way, uh, we have not seen that. So if you look at May 2025 inflation at about 2.4%. This slide does not have June inflation because we have not quite got that yet. So what we've seen in the last 3 months, May, April, and March, we can see on the far right end here that we've kind of been hovering around that 2.5, 2.4% inflation figure. So thus far, kind of as we suspected, tariffs have not driven inflation. And we can see in terms of negatives down here, energy is helping pull inflation down. And Evan showed us that oil and gas prices are down on the year and certainly down on the last 12 months. And that's what these figures here show. We can still see the biggest driver of inflation is that shelter cost. Now, a lot goes into shelter in terms of what's factored in for inflation. It's rent, of course, but a lot of people don't rent, they own. So there's an owner's equivalency figure that they put into there. And with interest rates high, home prices still elevated, we're seeing shelter still be the main driver. Now we've seen rents and home prices start to level off, if not decline, and there's a little bit of a lagging effect. So we expect that shelter component to be driving down. So as far as the first part of the Fed's mandate, dual mandate inflation, we're seeing inflation return to much more reasonable figures, and that's part of why you're hearing some folks say the Fed, ought to be cutting. The other side of that is job growth, and job growth remains solid. I won't go as far as to say it's robust, but I will say that it's remained solid. Now, if we look at kind of the last 3, 4 months over here on the right side of the chart, we can see jobs are coming in right around 150,000 a month or so. And again, I would say that that's solid. Nothing to consider it being a super robust job market, but we're seeing the jobs market hang in there. And we won't get too much into it today, but we like to kind of go under the hood when it comes to the job reports and not just see, okay, what's the total number and take that at face value. We want to see where those jobs are coming from. And if you look at it, we really want to see those jobs coming in the private sector because that's where true economic growth is derived. And I would say that it's hanging in there, but we want to see better private job growth. So as of right now, jobs are hanging in there, but they have moderated a little bit, particularly in the private sector. So that's why another reason why you see some folks saying, okay, jobs numbers are solid, but have come down moderately. Inflation has come down quite a bit. The Federal Reserve is due for 2 to 3 cuts, is what the market's pricing in. I think, it's always a moving target, and the Fed is hard to predict. But I think here internally, we probably expect 2 cuts this year, barring any kind of real major economic slowdown, in which case they would probably accelerate that. So we think the Fed's due for a couple of cuts this year because we do see jobs and inflation coming down and moderating a little bit. Now, the economy as a whole is, of course, measured generally by GDP, gross domestic product. And what we have on the screen here is a chart of GDP going back the last 4 or 5 years. And for those of you that were tuned into the news, in the first quarter of this year, we had negative GDP of 0.5%. That's the first negative GDP we've seen since the first quarter of 2022. Now, what are the reasons for negative GDP? And no one likes negative GDP, but is it as bad as it seems? I'm here to suggest that it's not as bad as it seems, and I'll show you why. So if we look at this bar on the far right, we can see this big negative drag here in purple, and that's net exports. So what are we importing versus exporting? And you can see over the last 24 years, the average of net exports, the contribution to GDP has been pretty flat, negative 0.1. We run a deficit on trade, so it normally subtracts a little bit, but not a meaningful amount. In the first quarter of 2025, it subtracted 4.6% from GDP. So if GDP is negative 0.5 and it subtracted negative 0.46, that's the sole reason as to why GDP was negative effectively. And now, why were net exports so low? It's because the folks in the market and the economy knew that tariffs were coming. So we saw a major front running of importing goods so that they could get ahead of the tariffs and not have to pay that extra tariff charge when it comes in. Um, for example, we had a handful of clients that were buying cars in the first quarter, and as long as they got their purchase in, by the end of March or early April, their car, if they came from overseas, had already come in, so they just evaded the price of their car going up by an extra 5 to 10,000 or whatever it may be. Now, we like to track or really dial in on what is kind of considered to be core GDP. So if you look at core GDP, that's going to be consumption. And consumption is about 68% of GDP. So what are consumers consuming? That's the main driver of GDP. A little over 2/3 of the economy is driven by consumption. Now that was pretty weak in the first quarter. We can see up here it added 0.3% to GDP. And on average, we get about 1.7% added to GDP as a result of consumption. So consumption was also pretty low in the first quarter. And there's a few reasons for that. Consumers on the lower end of the spectrum are getting stretched because inflation, even though we've seen it come down, that does not mean prices have come down. Inflation, the costs are already built in. That 9% that we saw back in 2022, that's built in, and then the 2.4% or so that we're getting now is built on top of that. So prices are not coming down. The rate in which they're increasing is coming down. So that's stretching consumers on the bottom half of the economy. So they're relatively stagnant. Now, also, folks, again, just like businesses wanted to front run the tariffs and import, a lot of consumers said, I'm going to maybe kind of see how this shakes out with tariffs. Maybe I won't buy as much. So consumption was pretty low. But the other components of core GDP are government, I'm sorry, business investment and home building. So if you look at consumer spending, home building, and business investment, core GDP was about 1.9%. So not amazing, but somewhat solid. And if we look at the 24-year average of 2.3%, not far off. So it's a little deceiving when you see a negative 0.5%. There's reasons for that, mostly imports. But in general, the economy in the first quarter was actually relatively solid. But where do we stand in the second quarter? The Atlanta Federal Reserve Bank puts out a weekly forecast. They call it their GDP Now estimate of where they see. So it's kind of an up-to-date tracker of where we see GDP growth. So if we look at GDP growth for what's estimated for the second quarter, and this is as of July 9th, last week, they release it again later this week, it's at 2.6%. So we're likely to see a decent rebound in GDP in the second quarter. 2.6% is kind of the current estimate. And it's because we're going to see that net export number really come back in line with what we normally would expect to see. So the economy, again, maybe not overly robust by any means, but it's, kind of hanging in there and staying on relatively solid footing. Okay, so One thing that, Evan talked about is in terms of interest rates is, the debt and the deficit, and maybe that's why we're seeing longer term interest rates kind of normalize, but also stay relatively elevated compared to what we've seen, really since the great financial crisis when the Fed cut rates to effectively zero. So what we have on the screen here is percentage debt as a percentage of GDP. So we can see how the US compares here on the left-hand side of the screen. We're at about 121% of GDP, and that's, pretty close with a lot of the other major countries and economies. Half of what Japan is. Japan has completely ballooned their debt and has had pretty stagnant growth. We're doing a little better than Italy and Greece, and a little worse than France and Canada and the UK. What you normally want to see is certainly 100% or less. We are accumulating debt at a faster clip than we're growing GDP, and that, of course, is not what we want to see from a sustainability perspective long term. So 121% GDP, I think currently GDP is around just shy of $30 trillion on an annualized basis, and our debt is just shy of 37 trillion. So our debt is outpacing GDP. Now, who owns our debt? You hear, at least in the financial media, you hear concerns are foreign investors or foreign lenders souring on the US economy. In our green line here, it's about 10% is from foreign bondholders. Yes, that is down from what we've seen going back through 2018, but still kind of in that range of 10 to 20%. So that's not overly concerning. We've actually seen the Federal Reserve's percentage go down, which is good because if the Fed is holding a higher percentage, that's going to drive inflation because they're effectively printing money and using that money to buy bonds. So we're actually kind of glad that we've seen that go down. And the big bulk of it is investment funds. So, funds that we utilize for you and your portfolios. About 2/3 of that debt is held in investment funds. So along those lines, we're focusing a little more on the federal government's kind of balance sheet and income, so to speak, and spending, because we're pretty big believers that that's why longer term interest rates may be kind of higher for longer, is so to speak. So if we look at total spending for 2025, the budget's $7 trillion. If we look at what we're going to pull in from income taxes, payroll taxes, corporate and other, we're looking at just above 5 trillion. So that means that 1.9 trillion deficit, and I'll honestly be surprised if it's not a little bit higher than that, needs to be debt finance, meaning we're going to have to issue more treasury bonds and bills to pay for that. So something we track, or at least internally in our investment committee, is what is the federal deficit as a percentage of GDP? We can see right now we're up here pretty high, and in 2024 it was about 6.4%. And here's kind of estimates of it moving forward, staying in that same general area. And the one big beautiful bill that was just passed is projected to add, in these little red bars here, add even a little bit more and keep us close to 7%. You really want to see it down near 3%. So that means two things. The government needs to cut spending, which they've shown no appetite for truly doing, or the other component of that is GDP. We need to grow at a faster rate. You will hear people on one side say, we think we're going to increase growth and therefore it's going to come down as a result of that. You'll hear opponents say, growth is going to kind of be what it has been, and we're just going to spend too much. So we'll see how that shakes out. But a big thing we like to track and want to see come down is deficit as a percentage of GDP. And then this just shows federal debt as a percentage of GDP, net federal debt, which includes assets. So, we saw it was 121% of total debt, net debt, which includes what's in the Social Security trust fund and all of that, right around 98. approaching 100%. So one thing that's pretty interesting when we really do not have a revenue problem. We don't have a tax receipt problem. We have a spending problem when it comes to the government. Right here, if we're expected to bring in over $5 trillion in revenue in 2019 pre-COVID, our budget was $4.45 trillion. We'd be running a $500 million surplus if we went back to 2019 spending. So we jacked spending up in COVID because we shut the economy down, and it's come down a little bit, but we've just kept it at elevated levels. So it's really a spending issue. And if we see spending come down somehow or GDP growth go up, then we might see longer term bonds and therefore mortgages and whatnot come down. Okay, so as I mentioned, the consumer is really the main driver of the economy. 68% of GDP is made up of consumption. And I talked about how consumers are getting a little bit stretched, and we're really in kind of a two-tiered economic environment at this point. We've got the affluent and wealthy, and then we've got everybody else. So Market Watch, which is a publication, they did a survey of 2,000 American adults and asked if they're living paycheck to paycheck. Now, of all respondents, 57% said yes. So that's obviously a pretty high number. Over half of the folks in this country, based off of this one survey, are living paycheck to paycheck. And it's really, the younger you are, the harder it is. 72% for Gen Z, 65% for millennials, 57% for Gen X, 44% for boomers, and the silent generation at 20, I don't think many of them are pulling in a paycheck, but some of them are living on fixed income, and that's where that comes from. So too many Americans are living paycheck to paycheck, and if you're living paycheck to paycheck, you're certainly not saving. You probably don't have much in savings. And we can see on the left-hand side of our screen, the top 10% of earners now account for half of all spending. So if over 2/3 of our economy is made up from consumption and spending, and half of that is coming from just the top 10%, when we look at the economy, the top 10% is skewing things to a pretty large degree, making it seem like, hey, GDP, employment numbers like this are looking pretty solid. But again, if you dig under the hood a little bit, there's a large subset of the country who's really just scraping by. And that's why inflation was such a big deal in 2021 and 2022 when it ratcheted up like that, because the average American was losing purchasing power. And we'll show a slide here in a moment. But so if the consumer is getting stretched, how is the consumer doing on the whole? And like I said, it's skewed because the top 10, 20% are doing pretty darn well. So that skews the averages quite a bit. So if we look at the balance sheet, I mean, we've got 190 trillion in total assets compared to 21 trillion in total liabilities. Again, we've got, pension funds, homes, and then other financial assets at 43% of the balance sheet here, or the assets on the balance sheet. That's all owned by, the folks who are doing better. So that number is a little skewed, but an important number to track is households' debt service ratio. So what are our debt payments as a percentage of our disposable income? We're not seeing alarm bells here yet. While it's certainly increased from when they pumped trillions and trillions of dollars of cash into the system following COVID, that number plummeted. You can see in great financial crisis, we got up near 16%. And then as we came out of that, we've been hovering right around 12%, maybe a little below, and now we're at 11.3. So on average, households are still doing good from that perspective, but again, it's skewed towards the top. Now, a way to kind of take out the averages and the skews is looking at delinquencies of different types of debt. So car loans, credit cards, student loans, and mortgages. So in orange, we have student loans. You see those jack back up here because student loans were suspended for quite a while during COVID, and they just kicked that back in. So that's kind of back to normal levels. What we can see here in the green and darker blue are auto loans and credit cards at around 8.8 and 8% over here. So that's the highest clip we've got going back to about 2011, 2012 on the back end of the Great Recession. So those numbers are ticking up higher than we want to see, and we are going to closely follow that to get a good idea of, how consumers are doing. And then mortgage, you can see that that's ticked up down here as well. Not at an alarming rate, but if we go back, probably the highest since, 2016 or so. So we're starting again to see the consumer, the average consumer, get stretched. And I mentioned real wages, so purchasing power. What is wage growth? What is inflation? So wage growth is the dark line here. Inflation is the light blue line. And then real wages, which is the nominal wage growth minus inflation. We can see here when inflation really started shooting up in 21 through 22, it took us all the way through, a handful of months into 2023 just to get back to positive territory. So when you are for over 2 years losing purchasing power, that really hits the bottom half of the average Americans quite a bit. But since then, we've kind of been trending at least at a positive range, which is good to see. We're kind of slowly climbing out of that, at least treading and not getting worse there. Okay, so I want to end with housing because housing affects all of us. Most of us live in a home. So I think if you look around your neighborhoods, you're probably seeing a lot more for sale signs than you've seen in the past. So there's, of course, sales of existing homes, which is on the left, and then there's sales of new homes, so homes that are newly built on the right. So on the right, we can see certainly from our COVID-induced spike, we've come down quite a bit, but we're kind of at what I would say more of a long-term average there. So new home sales are hanging in there. A large reason for that actually is these home builders are able to offer a lot of concessions and a lot of rate buy downs and things like that. But on the left-hand side here, existing home sales, I mean, look what they did as a result of COVID. People were buying homes at just massive rates. Interest rates plummeted super low. Cash was infused into the system, so people were moving and buying homes. Not only have we plummeted from that, we're near lows going back quite a while and well below where we were pre-COVID. And existing home sales make up 90% of all home sales. So while new home sales are hanging in there, they're only about 10% of the overall sale data. So the whole reason I show this is because housing is a pretty big part of the economy and it's really stalled out quite a bit. And we can see why that is. There are about 500,000 more sellers than there are buyers in the market right now. And again, here, if we look at COVID, look how many more buyers there were than sellers. So we're seeing prices actually kind of start to come down. In the Denver area, I saw a report, homes peaked in late summer 2022, and prices are down about 7% in the Denver metro area since then. So we're talking about 3 years of no home price growth on average in Denver. And we're seeing that in a lot of areas like Florida and Texas that boomed quite a bit during COVID, kind of come back down to earth. And so, a lot of you, maybe thinking about moving or downsizing in retirement or have kids or grandkids that may be looking to purchase. It's just really put a strain as we've seen Gen Z. A lot of them are living paycheck to paycheck. I actually saw a report this morning. First-time home buyers hit the lowest number ever as a percentage of total buyers. So those younger folks are really getting stretched. Home prices, while they've moderate stalled and come down maybe slightly, are still really high. If you bought a $700,000 house at 3%, someone who hasn't been able to save money for the last 5 years and doesn't have a down payment for that kind of house price at a 7% mortgage, just not going to be able to buy that house. So we're actually kind of expecting home prices probably to continue trending down over the next year or two. So just found that to be pretty interesting, and housing, of course, affects everybody. So with that, we have some interesting market perspectives that I'm going to turn it back over to Evan, and Evan will kind of take us through that, and we'll be wrapping up and getting into our Q&A.
All right. Thank you, Drew. That was great. Yeah, just a couple slides left, and we'll get you on to the rest of your day. Just kind of market perspectives, right? So when we're going through the market on a day-to-day basis, if you're sitting there watching the ups and downs, you can add some anxiety, some uncertainty. But when you kind of pull the curtain back, you step back and you say, okay, why am I investing? What's the goal? If I have a long-term view of investing in the stock market, it will typically pay off for you. And what this is showing us here is basically the last 100 years. So this is 99 years worth on the S&P 500. And each and every single year of those 99 is on here. And it splits it up between positive years and negative years. There were 73 positive years, and there were 26 negative years. Okay, so basically 3 out of every 4 years, we see a positive stock market. All right, the average return on the S&P, including the ups and downs over those 99 years, is 10.4%. All right, what I found is very interesting here is when the market is up, it typically is up more than that 10.4% average. Because if you look down here on the chart, the up 7 to 14% range has the smallest number of years. So that 10% average would fit in this right here, where it has the smallest number of years that actually landed there. The vast majority of them were up 14% or more, and the biggest chunk was actually up 28% or more. So again, being in the market, taking advantage of those up years is key to long-term investing. On the downside, the average negative return of those 26 years was down 13.4%. All right, and if we look, that does fit into the category here that has the most number of years. So down 7 to 14, there's a good chunk of them in here. And as you move out further to the left, there's only 8 years out of those 99 that were down more than 14% at the end of the year. All right, volatility can happen. Typically, it happens pretty quickly, but being back in the market and staying in the market as it recovers is key to success over the long term, whether it's saving for retirement or just being in the market in general. If you have a long-term view, you're gonna be just fine, because the market goes up over time, and according to this, 3 out of every 4 years. All right, and what's the probability of having positive returns in the market? Again, on any given day, it's basically 50-50, whether the market's up or down. It's slightly more on the upside. So 53% of the time, the market is positive on any given day. If you take a look at over a 1 month time period, 63% of the time, the market is positive. Okay, over a 1 month time period. This is going back to 1937. So over a year, again, I was talking about basically 3 out of every 4 years, the market's up. It's 77.5% chance of it being positive if you look from 1937 on. But what I wanted to point out here is look at the 10-year. If you're invested over 10 years, you have a 97.5% chance, according to this, of having a positive return at the end of the 10 years. This is a rolling 10 years going back from 1937. Being in the market is the best way to accumulate and build wealth over time. All right, last slide here, then I'll give a quick shout out to some updates that we have coming. What this is showing here is what happens to a portfolio, a 60% stock, 40% bond portfolio that you started in 2019 if you don't rebalance it. And the reason I'm bringing this up is because we're about to go through a rebalance. But in 2019, January 2019, if you have a breakout here of 40% in fixed income or bonds, 10% international stocks, 25% in US growth stocks and 25% in US value stocks. So you had a nice even split between growth and value. And we didn't rebalance it at all. We just let the portfolio move over time. And you can see as we get to the end here, currently, because the stock market has outperformed bonds, our bond percentage went from 40% down to 27. International stocks actually stayed right at 10%, but the growth happened on the US growth stocks, those tech ones we talked about, 37% now versus the 25% allocation that we started with. Okay, so the growth really happened in US growth stocks, taking it away from bonds. And so what we look at this and we say, okay, that makes sense because stocks usually outperform. But if we don't rebalance, look at our exposure now. What if US growth stocks had a really bad run here? Okay, you're a moderate investor if you are one. That's 60%, 40% bonds. Now you only have 20% in bonds, which are supposed to be the safer holding. That's a problem because now we are taking on too much risk in stocks. So what we want to do is sell the winners, buy the losers when we do rebalancing, to keep you in your risk tolerance and also make sure we're diversified and appropriately investing your portfolio for you. So we do have a rebalance coming. We do semi-annual rebalancing. And so our third quarter rebalancing is going to be starting and completing next week. So the week of July 21st, we'll be rebalancing portfolios. We are going to be sending out a memo this week that will be saying, hey, you're in a model that will be rebalanced the week of July 21st. Now we do have some clients who have custom accounts that may not be a part of that, but for the most part, we will do rebalancing next week. If for some reason you have questions or concerns around it, please reach out to us. We want to make sure that your concerns are taken care of before we make any rebalancing trades. And finally, just a quick plug for our next webinar, which we don't have a specific date yet, but it's going to happen in August. In August, the financial planning department is going to put on a webinar. It'll be Drew and Ryan are going to do a breakdown of the One Big Beautiful Bill Act. Okay, so that just passed. There's a lot of information that we still need to dive through and get updated on, and we'll make sure that it's specific and particular to clients in terms of taxes and financial planning and those types of things. And this is just a quick snapshot of individual key provisions in the bill with current law, what the bill said when it came to the House and the Senate and actually then approved as a final bill in terms of standard deductions, individual income tax rates, personal exemptions, child tax credit, whatever it might be. We are going to dive into this stuff. Should be very, very interesting. We will get a date set and communication sent out so everybody knows when that is here soon enough. And please sign up. Invite whoever you want to join because I think it's going to be awesome. Drew and Ryan are great when it comes to diving into the details and understanding how it's going to impact our clients. So we'll be sure to get that out to you guys. So that is it for us. I'm going to check here in a second, see if we have any questions in the queue. I'm going to pop through a couple disclosures here. Does not look like we have any open questions yet. This is your chance as I'm clicking through the disclosures. This is recorded, and we are going to send it out. So again, you can, if you want to rewatch it, send it to somebody if you have questions outside of today because you may not have thought of any at the moment. Please send it our way. We went a couple minutes over. Hopefully that was valuable for you. Let's see, we might have a question coming in. Do we have a question coming in? Hold on here.
And if you go to your control panel, there is a Q&A box.
Oh, yeah.
If it's not showing you that option, there should be an area where you can expand it to more options, which will then show it. So if you kind of hover over your your box, it should have three little dots that say more, and then you can see a Q&A section. So if you want, looks like someone tried to raise their hand. We don't have the ability to allow you access to the microphone. So if you want to type a question in, please feel free to do it that way.
All right, we'll give it another 30 seconds. If for some reason your question didn't get in, again, just shoot it to us directly and we'll make sure to answer it for you. Hope everybody's enjoying their summer and the week is off to a good start. One more check here on the Q&A. All right, it looks like we don't have any questions coming in. So we are going to go ahead and close it down here. Again, thanks again for joining, and we'll talk to you soon. We'll send out that communication around the next webinar here soon enough.
Thanks, everyone.